Okay. Good evening, everyone. My name is Wasiu Okpola. I am one of the lecturers that will take you on corporate reporting this diet, May 2025 diet. Myself and Mr. Abiodun will take you through the entire length and breadth of the corporate reporting syllabus. And you're welcome to Equity Professionals. So today, I have two missions. First, I will quickly show you how we want to achieve or we have vis-a-vis the syllabus. What I want to teach you and the timeline for achieving them. And secondly, we'll start the first topic and finish it. So in front of you is the corporate reporting course allocation. And as you can see, today, which is January 6th, we'll be looking at regulatory framework. Hopefully we'll finish it on time. Then we'll move to conceptual framework next week. These two, according to your syllabus, is 10%. According to your syllabus, 10%. Just that in recent time, when I say recent time, from 2023, November, we have not really seen questions on this part of your syllabus. So ICAN has been very focused more on accounting standards, like diet, purely accounting standards. The diet before that, purely accounting standards. So they have not really asked much in this area, but that could change. So we'll take it very seriously because your syllabus says it's 10%. Then we move to IFRS 2 share-based payments. That will take me 2 classes to finish properly, every aspect of it. 2 classes. That means by the end of IFRS 2, that will be the end of January. That means you are done with January. Then in February, we'll move to IAS 19 employee benefits. That will also take me 2 weeks to finish it properly. And I mean, it's going to be best if we are finishing these topics earlier than planned. That'll be good for you, even though I don't want to rush you. It doesn't worth it. So, I mean, what is important is we are not moving behind our plan. Then we move to financial instruments. This will take me 3 weeks to cover. 3 weeks to cover it very well. Already, by the time we are finishing this, we're in March already. Fair value measurements, a class. Then we move to IAS 21. The effect of changes in foreign exchange rates, 1 class. IAS 36, 2 classes. 2 classes because of corrections. I mean, there are a lot of past corrections. I can like to ask IAS 36. So solve series of past corrections. I've sent you my text, so you already have access to all the notes that we are going to be using for this diet. You have access to them already. Then when we're done with that, we move to IFRS 16. Two weeks Then IFRS 15 on revenue, A class. IAS 8 will be pending. I'm not taking it immediately after. B? Yeah. The one I'm taking is after 14th. I will most likely be taking that will be 21st, 24th, yeah. 21st. After 21st, I'll be taking 28th. That means my next is going to be ratio, April 28th, ratio. Then this April 28th will probably be the final week in April, for which we'll have exhausted all the 17 weeks that we have normally. So if I'm meeting you just on Monday, this time that we have, I'm not going to cover what I have in front of you. If you're diligent we resume 8, we close. I can close 11. So maybe worst case, I'll close 10:30, like that, diligent. You can't finish these things. I mean, I want an effective class. I don't want a lengthy class. I want an effective class, even if it is 1.5 hours. Let it be effective. Let's know that you have learned, like that. Okay, so the only solution is for us to cover other things that we have here, like IS 8, like ethical issues, like operating segments, like interim financial reports, like related party disclosures, all that information in the annual report, beyond financial reports. You see, I've already put dates there because I've looked at how do I want to cover up. There are two options open to us. Number one option is public holidays. I don't want to use your public holiday. I don't like to use public holiday for classes. So the alternative is to add one more day. And I started adding that that additional days from April 3rd. I mean, that means we're close to the exam. So January, February, March, you're moving, you're gaining confidence, you'll have learned the major areas you need to learn. So in April, we'll have one more day. That means I'm going to be teaching you 2 days. And for now, I picked Thursdays. So April 3rd, IS 8. Then April 10th, IFRS 8. Then April 17th, IS 34. Then April 24th, ethical issues. The day I'm teaching you ethical issues is the same day I'm going to teach you other information in the annual report and beyond financial report. So usually, then that means our last class would be on ratios, like that. So it's a busy 17 weeks for us. And apparently, we're going to meet more than 17 times. Of course, today is counting already. So I've already added like additional 5 times. So we'll be meeting like 22 or 23. We'll be having like 23 contacts in this class. So it's a long journey. So we're going to make it enjoyable to a large extent. 23 meetings. My colleague, Mr. Abiodun, I'm sure he has told you what he will be taking you. Realistically, this part of your syllabus is close to, let me say, almost 70% of your syllabus. But I just put it like that based on the contact hours. But if I want to judge by your syllabus, it's almost 70%. So the major part here is group account. Group account is around 20-25%, 20-25%, like that. Considering the fact that it's always the question one, and question one the way it is now is not just purely group. You need to have good knowledge of standards to be able to tackle group account, as it were, now. Okay, so that's my first mission for today, and I've achieved that now. So as it is today, the promise we are making you is that we're going to cover all of this. We are certain that we will cover all of this. We're going to transfer that knowledge to you guys. We're 100% sure of that. So be assured that you will learn all of these things. But in addition to that, we are going to ensure that you actually learn them. Yeah, I know we are all adults, but you are still students. You always be busy. You don't have time to read. We're going to give you a lot of assignments. Some will do it, some will not do it. Believe me, we're going to come after those that won't do it. We won't let you rest. We'll come after you. And this class is going to be highly interactive. You can ask questions at any point that you wish. If you don't want to talk, it's really not compulsory. You can drop a chat. I'm seeing your chats live, so you can always attend to anything you do not understand. So we need to bridge that gap of that lack of physical touch. We need to bridge it by maintaining frequent interaction in this class. That will make the class more interesting. Okay, mission 1 completed. Any comments before we move to mission 2? Mission 2. I have shared you these notes, and this is what we're going to be using in vis-a-vis your past questions, vis-a-vis your past questions for this class. And as far as my part is concerned, the other lecturer is going to share his own notes. He will share you the collated also, not piecemeal. That will not work. He will share you the collated notes so that you have access to it. Yeah, I would advise you that this note is robust enough. It's 224 pages. That's just my own part. The other lecture, I'm sure his own too is not less than 200 pages. Please, so which other textbook do you need? Anyway, if you need the hard copy, we sell. We can deliver it to you if you want to buy. But I mean, soft copy works. It works for me. Should work for you too. You can print it by yourself, though it could be more expensive though. Okay, so what do you have in front of us? You have corporate reporting. See, the objective of corporate reporting is to develop competence of preparation and presentation of annual reports. See, there's a difference between annual reports and financial statements. Financial statement is inside the annual report. Those of you that did financial reporting at skills level, that's the difference between financial reporting that you learned at skills level and corporate reporting that you're learning now. Financial reporting, the focus is your ability to prepare financial statements. That was the focus. Here is beyond that. The focus is annual report. So, of course, you still need to know how to prepare financial statements. That's why we are teaching you a lot of standards. But in addition to that, you need to understand that there are other information in the annual report beyond the financial statements. We call them non-financial information. Non-financial information like sustainability reports, like integrated reports, like corporate governance reports, like risk management report. You need to be very familiar with those reports. You need to know why they are important. I'm going to teach you all of that. It's part of your syllabus. That makes an annual report. And that is what you need to learn in addition to financial statement. Just that those other areas, they are very easy to teach because I can only ask you to write a corporate governance report. What I can will ask you is the content of a corporate governance report. I can only ask you to present a sustainability report. They will only ask you who is the regulatory body or why is sustainability report important. Questions like that. You will see as we move on in this class. So we'll come to that. So please don't forget, understand what you want to learn in this class. In this class, our aim, myself and Mr. Abiodun, is we want to teach you how to prepare an annual report. Furthermore, I'm teaching you regulatory framework today. And the reason why this is the first topic is because the way an annual report is presented in Lagos State is exactly how it is presented anywhere in Nigeria. And as it is today, it is exactly how it is presented in over 100 countries. The same way. Why is that? It's because they have the same regulation. The same regulation. So it is important you understand that regulation very well. And that is what regulatory framework wants to look at. Regulatory framework. It's important you understand it. As an accountant, you need to know the regulation that governs your profession. Why are you doing what you're doing this way? Who is asking you to do it that way? Those are the regulations. So today, regulatory framework will consider the regulation that governs reporting. The regulation that governs reporting. And speaking about this regulatory framework, I'm going to be looking at two things, two issues under them. Number one is the rules and principles. The rules and principles. And these rules and principles, you can guess that those are the regulation. So I don't want to mention regulation again. I immediately replaced it because we here in reporting, we call it rules and principles. So first, rules and principles. We are going to look at the rules and principles that governs reporting. And secondly, we will look at the regulator. Who are the regulatory bodies? Because these rules and principles don't develop themselves. They are developed by people, individuals, bodies. Who are the regulator? And that is what we want to look at today. So today, when we're able to achieve that, then you can go to sleep. Now, starting with the rules and principles. Starting with the rules and principles. So in reporting, the rules and principles that governs how we prepare annual reports, we call them GAAP, which are the generally accepted accounting principles. In some jurisdiction, they call it practices, but here we call it principles. Generally accepted accounting principles. Every country has their own GAAP. I mean, in accounting, as an accountant, is something you should be that you should be used to, our GAAP. Oh, our local GAAP. Our local GAPs. I mean, when you say our local GAAP, then you're referring to the rules and principles that governs you. If you work with an organization and they make revenue and you enter into your books of account and credit that revenue. And another person from another profession asks, why are you crediting revenue? So that's the requirement of our local GAAP. I mean, indirectly, you are telling him that's the rule or principle. For us, that is how we do it. So technically speaking, you can tell them that's the requirement of our local GAAP. So I need you to start using those words if you have not been using it before. Now, when we talk about GAAP, our GAAP in Nigeria, there are three sources. There are three of them. There are three things that make up GAAP. Number one is national company law. Number two is national accounting standard. Number three is local stock exchange listing requirements. And you observe that I'm putting national, local. I'm localizing it. You know, every country of this world has their own GAAP. In Nigeria, we have ours. In Ghana, they have theirs. In US, they have theirs. So when I say national company law, I mean Nigerian company law, because our company law is different from that of another country. And this is Nigeria. So when I say national accounting standard, I mean accounting standard we use in Nigeria. It might be different from those used in other countries. The local stock exchange listing requirements, I mean the listing requirements we use in Nigeria. So what is an accounting standard? Of course, which is a GAAP, is a GAAP. When we say accounting standard, the first thing that needs to be clear, or that we need to clarify, is that sorry, somebody just sent me a message now that they are waiting for the lecturer. I mean, I'm already in class. Oh, are you still waiting for the lecturer? Now, the first thing we need to immediately clarify when it comes to accounting standard is that the accounting standard we use in Nigeria is the IFRS, which is the International Financial Reporting Standards, or the IAS, International Accounting Standard. That is the one we use in Nigeria. Whereas in the US, they use Financial Accounting Standard in the US. But I mean, that's not our focus. Our focus is IFRS, International Financial Reporting Standards. Is the same thing as IAS, International Accounting Standards. Some of you might have learned some of IAS or IFRS before now, while some might have not, but in any case, you are going to learn it now. So, this IFRS, you'll find out that they are extremely authoritative. They are very authoritative, and their mission is to teach us how we present or how we treat transactions and events. Any transaction you can think of. If your company sells goods, there's an IFRS that teach you or that directs you or that guides you on how to treat that. If you buy a car, there's an IFRS that directs you on how to treat that in your books. If you rent a building, there's an IFRS. If you're owing salary, there's an IFRS that teaches you how to treat that. If you invest in shares, there's an IFRS that teaches you how to treat that. Think of any transaction that we need to record in our books of account. there is an IFRS that teaches how to do that. So an accounting standard is authoritative. They know what they want and they tell you authoritatively and they expect you to follow it through. And basically, it's just how you treat transactions and events in the financials. That is their aim. The next one is the company law. Like I've mentioned, every country has their company law. In Nigeria, our popular company law is the CAMA 2020, Companies and Allied Matters Act of 2020. There is the BOFIA, the Banks and Other Financial Institution Act of 2020. There is the tax law, which of course, they are working on reviewing almost every part of our tax law would be, in fact, has been reviewed. It's just left to be approved by the National Assembly. Then we would have new set of tax laws. You see, all these are company laws. All these are company laws. Then there is the local stock exchange listing requirements. From the name, local stock exchange listing requirements, it means that for companies that want to be listed on the stock exchange, on the Nigerian stock exchange, the reporting requirement they are supposed to meet is this local stock exchange listing requirement. So this is usually spelled out by SEC. SEC has certain listing requirements. Every company that wants to be quoted on the stock market that they must meet. And when you meet those, you can become listed. And when you become listed, this listing requirement also contains the continuous reporting requirements you need to present to SEC for you to remain listed. I mean, you will have heard of on the news that a company gets delisted or a company's shares is suspended for failure to submit report to SEC. It happens. That means they are defaulting on listing requirements. When they do that, they will delist them. They will suspend trading on their shares. So, local stock exchange listing requirements. So when the examiner asks you sources of GAAP, which they have asked severally, you need to be able to tell them that they are the accounting standard, the company law, and the local stock exchange listing requirements. And for you to really get the ultimate marks, you need to be able to tell them the company, the accounting standard we use in Nigeria, if you're explaining this, you need to be able to tell them the company law we have in Nigeria. You need to be able to tell them the listing requirement. Okay, there's listing requirement is listing requirement. However, before I move to another thing, we are talking about GAAP, rules and principles that governs reporting. I mean, preparing reports, annual reports. How does the company law becomes a GAAP? What does company law has to do with financial report or listing requirement? What was the link? Because when we talk about company law, we are talking about CAMA, we are talking about BOFIA, we are talking about tax law. What do those have to do with the financial report? Is there any link? Can any of you see any link here? Anyone? Can anyone link it? So as not to waste our time. Look at the CAMA, for example. When you look at the length and breadth of CAMA, you will see that it's CAMA that prescribes the types of share capital companies can have, like ordinary share capital, like preference share capital, and even the classes like issued, paid up, and all of this. So, and when you check your financial report and you want to present your share capital, you will see company presenting it as either ordinary shares that is issued and the one that is paid up, or preference share capital like that. It's not accounting standard that teaches us that is the CAMA. In some other countries, they could give it another name, but in Nigeria, that's what we call it. The BOFIA, for example, it requires banks, because this BOFIA is industry specific. It deals with banks. It requires banks to make certain reserves. I think around section 15, subsection 1, that there are reserves they have to make or keep from their profits after tax. So today, if you check financial report of any bank, you see a lot of reserves. It's not the IFRS that is requesting that. It's the requirement of BOFIA. So you can see clearly that company law, like CAMA and BOFIA, they are also providing us with rules and principles on how we prepare financial reports with all these their requirements. Look at the tax law. It is the tax law that determines how we get the value of our income tax. It's not the accounting standard. It's the tax law that will tell you expenses that you should disallow, expenses that you should allow, income that are exempt. And ultimately, when you now get your assessable profit, it will tell you, okay, there's a 66 to third capital allowance that you can enjoy before you get your taxable profit. And it's not tell you again, okay, you can only, we are going to assess you to 30% income tax. In addition to that, you also suffer 3% education tax. You're also going to suffer, you're also going to suffer 0.05% Nigerian Police Fund levy. There is NIFDA, there is NASENI, and all of that. And you will now say that if you make losses, you pay minimum tax, in as much as you are over 4 years in operation. You see, ultimately, all of these determine our current tax. Current tax that we put in the financial report is not IAS 12. IAS 12 will just tell you what you debit and what you credit. And it focuses more on deferred tax, really. The tax law is a gap, is a rule and principle that governs reporting. It has an input. Your withholding tax that you put in the account, your tax, your VAT, and all of that, they are determined by the tax law. Therefore, the gap are the accounting standards, the company law, and the local stock exchange listing requirements. These listing requirements, you will hear SEC asking listed entities that they need to submit quarterly reports, and they will tell them how they should prepare that quarterly report. They will tell them the items that they want to see there. They don't want to see the full report. They will tell them condensed report. It's a gap. It's a rule telling us how you prepare your report. However, as far as corporate reporting is concerned, we are not going to be talking about company laws. We are not going to be talking about local stock exchange listing requirements. The aspect of gap we are focused on is accounting standards. But that does not mean accounting standard is just the gap that we have in Nigeria. No, there are 3 sources of them: the accounting standards, the company law, and the local stock exchange listing requirements. Those are the gap. So when we say local gap, those are the 3 we are talking about. Just that for us accountants, when we say local gap, I mean, immediately we think we are talking about just IFRS, but it's beyond that. It is beyond that. So my dear students, I kind of asked it before. They will ask it again, that you should list and explain the sources of Nigerian gap. Please don't hesitate to list these 3 and explain it to them, and pick your 6 point. your 6 points or your 6 marks in the exam. Furthermore, speaking about rules and principles, we already established that these rules and principles is the gap. We already established that's gap. But we cannot shy away from the fact that rules and principles does not mean the same thing. They are not the same. They are different. Rules, principles are not the same. If you check the English dictionary for principles, just check Google principle. It will give you a lot of definitions, but the core meaning of principle is like a general truth or a fundamental truth or a proposal. Usually will give you like a foundation for a chain of reasoning. Is a proposal, is a guide that will push you to reason. For example, now, Google Map, for example, Google Map. If you are going to, let's say you're in Lagos, and you're going from the mainland to the island, and you put Google Map there, okay, I'm going to Lekki Phase 1. You will see Google Map giving you series of alternatives, and it will tell you the basis. Why it's telling you to go like this, go like that, 15 minutes, 20 minutes. So it's not left for you to choose, left to your judgment. If you want to pass Third Mainland, then from Third Mainland, you link Ikoyi Link Bridge, or you go and pass Olowo Way, or you go and pass Akpogbon. You won't just go through Third Mainland, go through Surulere, then Joelegba, like that. It will give you several options. That is principle. The mission, the proposition is that I want to get to Phase 1 from the mainland. But I'm not telling you specifically how you get there. I'm giving you options. I'm leaving it to your judgment. So that's principle. Principle gives room for flexibility. Principle gives room for judgment. It doesn't enforce anything on you. It gives you option, then choose. So it's generally believed that standards like IFRS are principles. They are principles. So bringing it to accounting, if IFRS is principles, if they contain principles, then we can say that in Nigeria, our regulatory framework is a principle-based framework. I mean, you need to be able to use that word. I can ask you. You need to know the type of regulatory framework you operate. If we say IFRS is principles, that means our regulatory framework is a principle-based framework. Rules. Rules are extremely specific, explicit, codified, written, clear. And the thing about rule is that they assume you understand it. They assume you know it. They assume you know it. If you dare not follow what they have asked you to follow, you will be punished. That is rule. They will punish you because they assume it's a rule. It's clear. That's how they want you to do it. They don't want any infractions. They don't want any diversions. No, they don't want you to think. They don't want you to think. I've gone to an interview in a multinational. Then after the whole process, when we met the Oga, the guy said, "Here, we don't want you to think. We already have our processes laid down. Just do what we ask you to do. Don't think." That is rule. So when you are in an environment or in a country where their reporting framework contains rules, everything step by step. They already know, just follow it. There's a checklist, just check it. Then we say that that's a rule-based framework. That's a rule-based framework. So I kind of asked you this before. I kind of actually asked you this before. So everything was around the advantages and disadvantages of rule-based framework and principle-based framework. I think it was 15 marks. They splitted it. I'll show you that question anyway. So I really need you to think about this. I really need you to appreciate this. And as a professional, most of you will qualify this diet. As a professional, you need to have where you stand. For me now, as a person, I think I would prefer a rule-based framework. I would like IFRS to be rule-based because there's too much manipulation. Auditors are doing so much because people are using their judgments. You say it's principle-based, we have options. No, let there be rules. Principle rule-based, I feel it's very clear. And there won't be room for manipulation or fraud. There's no way you can do that. It will be very difficult because it's rule. And you know you'll be punished. So there's no way somebody will think that, okay, it's unintentional. It's intentional if you don't follow it. And it's going to reduce, reporting will be more reliable. That is what I think. Another school of thought might think otherwise. Whatever it is, I feel rules are clear. They foster comparability. Everybody will do it the same way. It avoids ambiguity. It ensures consistency. Think of it. Other people will say principles. They will say, yeah, principles, it allows for flexibility. It's adaptable. When things are changing, it can change with economic environment. And it's easy to improve on, to get improved on, and like that. I won't say anyone is wrong or right. So everybody with their school of thought. So I really want you to, this is in the text I've shared with you. I want you to look through them. Don't cram it. Think about it. Because how many things do you want to cram here? And ultimately, they might not even ask it in the exam. So you need to understand where you stand. This is the starting point of corporate reporting. Who are you? What do you want to preach when you qualify? Are you going to be preaching principle-based or rule-based? You have not really understand the concept if you cannot criticize it. If at your level now, most of you in this class, I don't want a yes or no sir mentality. You need to be able to criticize anything we tell you. Anybody that does that in this class will pass ICANN exam very, very easily. Very easy. You see, ICANN exam is very simple. For you to question existing ideas. That, okay, why is this? Right? So I need you to think about this. Where do you stand? So next week, after you must have gone through it, I would be wanting to know which school of thought do you think should be encouraged? Is it principle-based framework or rule-based framework? But for now, let's move on. Okay, I have everything here. Oh, quiz. Fantastic. I've been speaking for how many minutes now? Almost an hour. And I've not had opportunity to hear your voice. Now, I will hear your voices now. So quizzes. Question 1. This is the part when you're mute, or you can just type it, something like that. Financial reporting is governed by regulations. A, true. B, false. C, none of the above. What was the answer? That's correct. Number two, the rules or principles that governs financial reporting is known as A, GAAP, B, IFRS, C, SAS, D, IAS. That's correct. GAAP. That's correct. GAAP. Rules and principles that governs financial reporting is known as GAAP. That's correct. I thought you were going to say IFRS. You'll have been wrong. Number three, which of the following is not a GAAP? National Accounting Standards, National Tax Laws, National Company Laws, Local Stock Exchange Listing Requirements. Which of the following is not a GAAP? The tax law, the tax law. Okay, that's correct. The tax law is not a GAAP. Number three, IFRS is a rule-based framework. A, true, B, false. False. Yeah. It's principle based. Yeah, false. It's principle based. Yeah, false. Yeah, that's correct. False. IFRS is principle based. Okay, good. Yeah, that means you're following. Fantastic. Okay, so we are done with part one of this class. Remember, I told you that what I want to teach you in regulatory framework is two things. I want to teach you the rules and principles that governs reporting, which I've done now, which is the gap. And you know that a country can either have a principle-based framework or a rule-based framework. Before I move to regulatory bodies, in Nigeria, do we operate a rule-based framework or a principle-based framework? Which regulatory environment do we run in Nigeria? Rule-based or principle-based? Or both, Abi? It's possible to be both. Do you know you can actually talk if you want to? Okay, Bidemi said both. Yeah, Bidemi is right. No, Sonia, it's not rule. It's not just rule. Why Bidemi is right is this, right? Look at the gap itself now. The company law, like KAMA, like tax law, like BOFIA, all those acts, they are rule-based. They don't want your judgment. You don't reason. Like, look at this BOFIA now, section 15, subsection 1, that banks must make 30% reserve, whatever. So, if you don't do 30%, you're in trouble. The tax law will say this expense you must disallow, that one you must allow. If you don't do it, you're in trouble. So, the company law is rule-based. Well, accounting standard is principle-based. I mean, this is arguable because I would share why for you very soon, because it seems IFRS is moving to rule-based. I will tell you soon. So listing requirement is rule-based. So in Nigeria, it's actually both. So BDMI is perfectly correct. It's a combination of rule-based and principle-based. Okay, good. Very good. Okay, so let's go to regulatory body, the regulator. And if I may ask you, as far as reporting is concerned in Nigeria, I mean, when I say reporting, I mean preparation of reports and all of that. Who monitor, which body in Nigeria monitors that companies or auditors do the right thing? That the audited report that you present to investors or your users is correct? Do any one of you know the body in charge of that? ISA. Yeah, Korejo is correct. FRCN, Financial Reporting Council of Nigeria. Yes, that is the regulator. that monitors that. And that is the next thing we're looking at. Financial Reporting Council of Nigeria. All of you must know this. Please, if you don't know this one, of course, now you have known it anyway. FRCN, Financial Reporting Council of Nigeria. This is the regulatory body in charge of IFRS and IAS in Nigeria. Everything about reporting, they are the one in charge. They are the one that ensure that the audited report is presented in line with IFRS. So they came in 2011. That was exactly when Nigeria started adopting IFRS. That was when this guy came in. We used to have NASB, but that is none of our business anymore. And the thing is that, you see, every one of you, when you qualify, you need to have an FRCN number. Otherwise, you cannot sign an audited report. If you happen to be the engagement partner in your firm, you won't be able to sign an audited report without an FRCN number. And if you are currently a CFO, you don't need to qualify before you get an FRCN number. I mean, by virtue of your position, you could get, because you will need an FRCN number. But at least you need to show some level of competence to them to be able to award you on the basis of you wanting to sign an annual report. Or if you are the chairman of a company or the CEO, you can get an FRCN number. Because without that, you cannot sign an annual report. So one way or the other, every accountant needs to have an FRCN number. And it even extends to any professional that have an input into the financial report. They need to have an FRCN number. So like a valuer, for example, now, you see, when you want to value our building that we want to put in our account, you will need a valuer. Accountants are not trained in valuation, except if you had gone to other fields to learn about that. As far as accounting is concerned, we don't do valuation, except you have gone out to learn it. So we usually get the service of valuers. So those valuers, before we can rely on their report, they're also required to have an FRCN number. They need to be registered with FRCN. Even actuaries really, the one I will teach you about actuary is relating to defined benefit plan, specifically defined benefit asset and defined benefit obligations. I'll be teaching you that under IAS 19. It's actuary that help us do the valuations of those. So you find out that actuaries, they help us do valuations of our financial assets majorly, like that. Why valuers focuses on the non-monetary assets, non-financial assets. All of those must have an FRCN number. Okay, that aside. So, I mean, I've been able to show you that this body is actually very important. Now, what I can ask you, most of these things I'm saying, there are things you need to know that one way or the other you can help you in your exam. But one thing you need to seriously know that I have in this note is the objective of this FRCN, the objective. You see, when they were established in 2011, they gave them certain objectives. And the first and most important objective that they assigned to this FRCN is to protect investors and other stakeholders' interests. To protect investors and other stakeholders' interests. And this makes sense. This makes sense. Because, wait, why do companies prepare reports? They prepare reports so that investor can know how they have spent or used the resources that was entrusted in them. So basically, this report they prepare is for investors. Now, we are not saying there's a body that ensures that companies prepare these accounts, these reports the right way. Who are they protecting? The investor. Is the investor they are protecting. So it makes sense that their first objective is to protect investors and other stakeholders' interests. And believe me, every other objective that I have here is to achieve this first one. Look at it. The next objective is they provide guidance on issues relating to financial reporting and corporate governance to professional, institutional, and regulatory bodies. When I say they provide guidance, to put it simply, it means they teach companies, they teach them about financial reporting and corporate governance. So if you go to their website, FRCN website, you'll see links on to IFRS, IAS. They organize trainings, seminars, webinars like that for you to learn about financial reporting. Not only that, also corporate governance. FRCN is also in charge of corporate governance in Nigeria. If you want to know how the board should be structured, go and download the code of corporate governance from FRCN website. And they go all out to ensure that every company follow that code. Because they actually go out for audits to check your corporate governance structure. I mean, a company whereby is the MD, that is the alpha and omega in making decision about what happens to the report, the management report of that company lacks corporate governance. For corporate governance to exist, there needs to be a separation between who is the MD and who is the chairman. There have to be a board that even the MD will report to. The CFO should be reporting to the audit committee of the board. There needs to be a structure. If you read the code of corporate governance, he has strictly explained how a board structure should look like. What are the relevant committees that should be in that board? How should you remunerate the board? How should you remunerate those committees to ensure that companies are directed and controlled the right way, to ensure that whatever report comes out eventually is not manipulated? It is where there is corporate governance that we can have the right financial report. So it makes sense for Financial Reporting Council of Nigeria to be in charge of financial reporting and corporate governance. So they teach companies about financial reporting and corporate governance. The third objective is that, okay, we have taught you, then we need to ensure that you are doing it. So to ensure good corporate governance practices in the public and private sector of the Nigerian economy. So they go after companies. They ensure that they have good corporate governance practices, not just individual companies, not just limited companies. They go after those in the public sector, parastatals, agencies, they go after them. It was on the news last year that FRCN actually sanctioned one of parastatal, I won't mention the parastatal, and they asked them to withdraw their financial report. And withdraw it.
Definitely.
They go after those ones. And also, they also ensure. Okay, I've muted her. And also, they also ensure that financial reporting is accurate and reliable. Okay, since we have taught you about financial reporting and corporate governance, so we ensure that your corporate governance is right. We also ensure that your financial report is right. Then they harmonize activities of relevant professional and regulatory bodies as relating to corporate governance and financial reporting. They harmonize professional and regulatory bodies like ICANN, like CITN, like CIBN, like ANAN, all the regulatory bodies in Nigeria. FRCN looks into their affair. I mean, look at ICANN, for example. Most of you here, we are here to teach you on how to qualify. And who is setting the syllabus? ICAN. Who is setting the exam? ICAN. And it's whatever you have learned here that you're going to apply in practice. So FRCN needs to link into that. They need to harmonize their activities. But they are not doing the same thing. They should not be an overlap. They should not be conflicting one another. FRCN harmonize their activities. Then, of course, they promote the highest standards among auditors and other professionals engaged in financial reporting process. And ultimately, all of this will enhance the credibility of the financial report and improve the quality of accounting and auditing services, actuarial valuation, and corporate governance standards. That is the objective of, or these are the objective of the Financial Reporting Council of Nigeria. And these objectives are quite easy to learn, are quite easy to know because they follow one another sequentially, starting from the most important objective, which is to protect the interests of investors and other stakeholders, going into teaching companies about how to prepare reports and how to have good corporate governance and ensuring that they actually do it, looking into the affairs of regulatory bodies, ensuring auditors and other professionals they have good quality, they have highest standard, they ensure you improve their quality. You see FRCN going after auditing firms, ensuring that they do the right thing. You see them going after companies, ensuring that they have the right corporate governance framework, ensuring they comply with the IFRS. Now they are doing very little. Their MD right now is Rabiulu. Yeah, when it came in, yes, at least now we are hearing from them. Before Rabiulu, we were not hearing anything. They were just quiet. So I was like, okay, what are these guys doing? The last time I knew they really worked was prior 2015. I think they removed Jim Obaze in 2015. I don't know whether that name, Jim Obaze, rings a bell. Jim Obaze is the guy Tinubu actually employed to investigate CBN. He was the one that prepared that report that is flying around. And it's that report that inducted Emefiele. Like that. The guy is a very sound guy. So very intelligent. He was the one in charge of FRCN. When he was in charge, oh my God. Oh my God. He followed that is requirement to the letter because ordinarily, every company in Nigeria is supposed to submit their audited report to FRCN. FRCN will then look at it and ensure that you have complied with IFRS. If they see any infractions, they will invite you. They will invite the company representative, they will invite the auditors, they will invite the tax consultant. I've been invited before. So they will sit you down. That, okay, we saw this mistake. What happened? This is the requirement of the standard. You guys will argue, no, this is what the standard said. Everybody would present their points. Ultimately, if FRCN wins and they see that you did not comply with the standard the right way, they will say, okay, they will penalize you. They were really, really working that time. But after the guy left, these ones are just running after money up and down. Come and pay subscription. Come and pay subscription. The way FRS is doing now, FRS, those ones are after money, but the way they look into the law and say, no, this expense, you should disallow it. You should allow this one, and they would be on you, conduct audits, ensure that you pay the right amount of tax. That was the way FRCN was doing, ensuring that you comply with IFRS. But now they have mellowed down. I don't know. Yeah. You see, every one of us in this class, every one of us, it is our responsibility to help FRCN achieve this objective. And if you don't help them achieve it, it is an ethical issue. So, and you can be sanctioned for it. And I can even ask you that what are the ethical issues that FRCN can sanction entities for? The ethical issues that FRCN can sanction can sanction entities or companies for. Number one, from what I've said, I already mentioned everything. Number one is that if a company allows someone or a professional that does not have an FRCN number to sign, whether your auditor, whether your CFO, and does not have an FRCN number, and you allow him to sign your report, it's an ethical issue. And it's an action for which a company will be sanctioned for. Or if you allow a professional like a valuer or an actuary without an FRCN number to provide you figures that you use in your report, it's a sanctionable action. Or when they come for audits, you did not allow them come in. They want to do audits and you refuse them access. It's a sanctionable action. Or even you as an accountant that is providing figures within your entity, you don't have an FRCN number, it's a sanctionable action. And many more like that. These are ethical issues that we need to avoid as accountants. Okay. Now, I need to tell you something, and I want you guys to keep it between us in this class. It must not go out there. And what I'm telling you is that it is not FRCN that develops IFRS. They are not the one. What they actually did in 2011 was to adopt IFRS. They actually adopted it. Even though in recent times, I kind of not really been asking questions around the actual body that develops IFRS. Because if you look at the Financial Reporting Council Act, the mandate given to FRCN was to develop accounting standard for Nigeria. Of course, in their mind, that is what they are doing, but the truth is that they actually adopted it. And it's important we accountants know that. But I mean, let's just maintain the sanctity of the profession and just assume that yes, they develop it, even though they do not. And that's why I can't themselves. You would not find any question around this body that actually develop it. You see them asking you about FRCN, because that's what they want you to know. That's what they want you to preach. But it's important you know the body in charge of IFRS. Where does IFRS actually come from? IFRS came from what we call an IFRS foundation structure. They call it three-tier structure. IFRS foundation structure. I mean, it's a modernized structure. They just modernized it in 2011. This body has actually been existing since the 1970s, because I can remember that IAS1, the first IAS1, the first standard was issued around 1973 or 1978, so it's a long time ago. But in 2005, they modernized, and that's what we are teaching you here. This diagram you're seeing in front of me, I coined it from the ifrs.org website. It's there. You can go there to look at it, but I've already summarized it for you here. So the reason they call this IFRS structure, the reason they call it three-tier structure is that there is the number one set of people, which they call monitoring board. Monitoring board. Then there is the second in command, which they call IFRS Foundation trustees. And the bottom people, who are the standard setters. There's the IASB, there's the ISSB, there's the IFRS Foundation Committee, there's the IFRS Advisory Council. So it's like a three-tier structure. the monitoring board, the IFRS Foundation's trustees, and the standard setters. What do they do? What do they do? Listen to me very closely. Let me summarize what they do. I've explained everything here. Everything is here, but what I've explained, let me just show you. Let me tell you. So the monitoring board, first, who are they? Who are the members in this monitoring board? The members of this monitoring board are capital market authorities. Again, the members of this monitoring board are capital market authorities. And by capital market authorities, I mean the regulator in charge of the stock market in respective countries. In Nigeria now, the capital market authority is the SEC, the Securities and Exchange Commission. That's our capital market authority. So the capital market authorities of major countries in all continents of this world are represented on this monitoring board. When I say all continents, I'm talking about Africa, America, South America, Australia, Europe, Asia, Antarctica, Oceania. They are all represented. And there's this IOSCO, International Organization of Security Commissions. He's a member here. He's a key member where all security exchange commissions belong. They are a key member here. I mean, the question should then be, okay, why is the Capital Market Authority the head, a member of monitoring board? Who is the head of this structure? Why? Makes sense, because the capital market authorities, for example, let's take for Nigeria, for example, SEC. I mean, if there is any body, any organization that understands the reporting need of investors, that understands the reporting need of investors, in SEC, if there is any organization that understands how they require companies to present reports to investor, is SEC. They understand them because they are the regulator. They deal with listed companies. They ask them to present reports every now and then. They know what investors require. So these guys are smart to put capital market authorities as the head of this structure. Therefore, having the market, because capital market authorities of major countries in every continent, being a member of this board, that means you are saying the markets, the people, come and head this structure. That goes to show that this structure is highly publicly accountable. And when I say publicly accountable, I'm saying that they don't do things the way they want it. They are doing things exactly how the public wants it done, because they know that ultimately they are working for the public and they would account to the public. That is public accountability. And having capital market authorities as a member of this board, as the head of the structure, it sees to that. It shows that this structure entirely is publicly accountable. Therefore, I can say that the monitoring board maintains a formal link between the public and this structure. I mean, there's a link between the public or the market or the investors. There's a link. It's like this structure listens. So the monitoring board is representing the people. So it maintains a formal link between the public and the structure. And that is it about monitoring board. That is all you need to know about them. Just three things I've mentioned. The members are capital market authorities. Having capital market authorities as the member ensure that they have public accountability. Thereby, they are the formal link between the public and the structure. The next one is the IFRS Foundation. And this IFRS Foundation, the people there, we call them trustees. And these trustees are now the professionals, people that have international experience, people that have worked in several countries, people that are exposed on issues relating to accounting, education, auditing, valuation. They understand it deep down. I mean, it would be nice some days in the future. I see some of you working with or being a member of the IFRS Foundation. It's very possible. And I look forward to that. So these guys are experts. Experts. So what they do here, they are the one that govern the structure. They strategize, they oversee the structure. And when they came in 2005, when they restructured, they gave this IFRS Foundation four objectives. Four objectives. Listen carefully. It's in these notes. I will show you. But listen, I need you to listen to me. They gave them four objectives. And we'll look at it together if they have met these four objectives. Number one, objective of this IFRS Foundation is to develop a single and global accounting standard in public interest. To develop a single and global accounting standard in public interest. What that means is that their aim in this life is that they want to be the one that will develop accounting standard that every company in this world will use. Have they achieved that? No, they haven't. And I'm sure they are strongly focused on achieving that. Though they are close, as it is today, over 100 countries use IFRS. So they are doing well. That's number one objective, to develop a single and global high quality standard in public interest. Number two, to promote the use and rigorous application of this IFRS, of this standard. Have they achieved this? Oh, yes, they have done so well. I just said that over 100 countries of the world this IFRS. So they have promoted the use and rigorous, look at the word, rigorous application. Let people apply it rigorously. They have done it so well. Number three, to take care of the need of SMEs and emerging economies. To take care of the needs of SMEs and emerging economies. I mean, it was this third objective that actually helped them. Because when they started, they actually focused on SMEs. When I say SMEs, I mean small and medium scale enterprises, SMEs. They focused on SMEs. Then gradually, they captured capital markets. I mean, they were strategic enough to make capital market authorities members of the monitoring board. So they know what they were doing. So with that, they captured listed entities in major capital markets in major countries. But notwithstanding, they focused on SMEs and emerging economies. When I say emerging economies, I mean developing continents, developing countries. And that is why, in fact, as it is today, almost all countries in Africa adopt IFRS. 100%. So when you guys qualify, you see that you can work anywhere in Africa. I mean, with your certificate, you will just probably write one or two papers and become chartered in any country in Africa. As it is today, most countries in Asia, which is an emerging economy, adopts IFRS. As it is today, most countries in South America, like the Argentina, Brazil, they adopt IFRS. Australia, they adopt IFRS. Antarctica, they adopt IFRS. Australia, they adopt IFRS. They focused on emerging economies. So that really helped them. And finally, to converge national accounting standards with international accounting standards, to converge, bring together. Why are they doing this? They know that some countries will not adopt it. Because as we speak today, United States, who is the world power, the country with the number one military power, the country with the number one economic power. I mean, speaking about GDP, they are the biggest economy in the world. They don't use IFRS. So what IFRS Foundation is doing is they are trying to converge IFRS with that of FAS. That's the standard they use in the United States, financial accounting standard. They're trying to converge it. And don't forget, I told you already that FAS is rule-based. So converging it means that IFRS might be moving from principle to rule. Yeah, they're already moving, because when I teach you IFRS 15 on revenue, you will see that now IFRS 15 requires that before you can recognize revenue, there are 5 steps. And if you don't follow these 5 steps, it will tell you that you have not properly recognized revenue. How is that principle? That is rule 5 step. If you don't follow this 5 step, you are wrong. That is rule. So, I mean, I can confidently say that IFRS is not entirely principle-based anymore as a result of this convergence with the FAS. Even the recent rule or principle on impairment of financial assets under IFRS 9, I will teach you guys. Now, there are stages when you originate a financial asset now. There are stages you need to pass through as regards accounting for their impairment. It's rule, because they will tell you stage 1, you do this, stage 2, you do this, stage 3, you do this, using expected credit loss model. We will get there. We'll get there. You guys are just starting. So, converge. You see, those are the 4 objectives of the IFRS Foundation. I have it. All these things I'm saying is here. So, I'm just saying it. Maybe in my subsequent classes, I'll probably use like a digital pen to be writing these things. I mean, maybe to be more interactive for you guys, but let's see. Okay, now the IFRS Foundation appoints these 2 bodies, standard setting bodies. They delegate their responsibility to them. The IASB, who is the International Accounting Standard Board, and the ISSB, who is the International Sustainability Standard Board. So the IASB first. The mission of these ones, their purpose in this life is to develop IFRS. So, I mean, when they ask some people that who develops IFRS, they will say it's IASB. I won't say they are wrong, but for you that are professionals, you should know that it's the IFRS Foundation. That's the first thing you should say. Then you can then explain to layman that, okay, however, they have delegated this responsibility to the IASB, to be specific. But the guy that is responsible is the IFRS Foundation. Even though they delegated it to IASB. There was a time ICANN asked that you should list the objective of the IASB. I mean, it's the same thing as the objective of the IFRS Foundation. Those four objectives I gave you, those are exactly the objective of the ISB because they are the same thing. The IFRS Foundation created these people to achieve their aim. They do the same thing. Then there is the ISSB, who is the International Sustainability Standard Board. These ones are in charge of sustainability reporting. They issue a standard called IFRS Sustainability Disclosure Standards. I won't be teaching you these standards at all because it's not within the scope of our syllabus yet. Even though Nigeria have started adopting this standard, it's not compulsory. Nigeria have started adopting this standard from 2023 November. So before now, you see, companies have been reporting sustainability, but there wasn't, we did not have like a structured standard. There are a lot of standards around, like that of Global Reporting Initiative. There was SASB and other bodies like that before now. There are many of them. But with ISSB now coming under the umbrella of IFRS Foundation, now we know where to follow. And it's important. Sustainability reporting is important. It's part of the issues we will discuss briefly later on in this class, because right now it's not just about companies reporting that they have made so much profit and all of that. They really need to explain to investors the impacts of their actions, of their economic activity on the environment. I mean, most investors now, they are becoming green aware. They are becoming a sustainable investor. They want to invest in companies that don't destroy the environment. So most companies are actually keen. They are keen to reporting about their sustainability activities, their sustainability initiatives, and all of that. So as it is today, there are two standards, IFRS S1 and IFRS S2 on sustainability. I might just give you some overview of it. I mean, just for you to be aware, but it's not something we would really be going in depth. Though I will show you some sample sustainability reports just for you to see how it is being prepared. I mean, just for your personal consumption and knowledge. Okay, so there is this other one, IFRS Interpretation Committee. This one works with the ISB because from the name, IFRS Interpretation Committee, you should see that what they do is to provide interpretations on IFRS. So does that mean that every IFRS has an interpretation? No, 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 no. That's not what we mean. You see, they come up with interpretation only in two situations, in two scenarios. Number one, if there is a conflict of opinion on application of an accounting standard, if there's a conflict of opinion on how we apply an accounting standard, then they come up with an interpretation. I mean, where there is some set of professionals that is saying that this is how we apply this standard, and there is another set of professionals that are saying that no, this is how we should apply. So there is a conflict, there's a clash. Then the interpretation committee will come up that no, this is how we do it. That's when they come up with an interpretation, when there is a clash of opinions. Number two is if we have a new transaction or a new event that we don't have an IFRS on how to treat it. There is a new transaction, a new event, and we don't have an IFRS on how to treat it. They come up with an interpretation. Like some years ago, they came up with an interpretation on how we treat cryptocurrency. Because when cryptocurrency start becoming popular, when companies started buying cryptocurrency as an investment, I mean, they need to report it in their books, and there was confusion because we didn't know what type of asset it is. So they came up with an interpretation. And I kind of asked it before, I think 2018. They asked you guys, how you account for cryptocurrency? Yeah, 2018, November. I think question 5, yeah. How you account for cryptocurrency. They give examples like Bitcoin, Dogecoin, and all of that. And they ask, how do you account for this? 15 marks. We're going to get there. I will teach you, I think, under financial instruments. We'll discuss it. So that is where this interpretation committee actually come up. And finally, if you look at the right, the one I painted red, I called it IFRS Advisory Council. And this IFRS Advisory Council, from their name, they provide advice to the IASB, to the ISSB, and to the trustee, the IFRS Advisory Council. But how do they provide advice? How do they do it? The way they do it is that, you see, this IFRS Advisory Council, they are the one that actually speaks to the public. They are the one that gets information from professionals in practice in public. So whenever the trustees or the ISB or the ISSB, whenever they need information or data from the public, they run to the IFRS Advisory Council. They are the one that goes to the public, whether with questionnaires, with interviews, or in whatever manner they can raise those data, they get them, and on that basis, they would advise any of them that needs those information. You see that this is a very structured organization. Everybody has their own responsibility, and they are doing it in a very structured way. And this is the structure behind IFRS in the world. And finally for today, oh, there are quizzes here. I mean, you guys have been quiet for almost another hour. Almost 40 minutes. I've been talking. Let's see if you are listening to me and that you are not sleeping. So, number 1, which of the following bodies provides the formal link between the trustees and capital market authorities? ISB, IFRS Advisory Council, Monitoring Board, Interpretation Committee, IFRS Foundation. Which of them? Ibukun, that's correct. Monitoring Board. Number 2, one of the following is not an objective of the IFRS Foundation. Help company prepare and present, develop in public interest, single, promote the use and application, take care of the needs of SMEs. Which of the following is not? Okay, that's correct. Both of you are correct. Yes, correct. Number 3, which of the following bodies is responsible for developing IFRS? Is it the IASB? Is it the Interpretation Committee? Is it the Advisory Council? Is it the IFRS Foundation? That's correct. That's very correct. I thought you were going to say IASB. That's correct. The foundation. Where there are conflicting opinions on the interpretation of an IFRS, which body resolves these conflicts? ISSB, Interpretation Committee, Advisory Council, Monitoring Board. Correct. Very correct. Yes. That's the Interpretation Committee. Okay, good. Okay, good. So, I mean, ordinarily, this class is over. In terms of we have achieved what we want to achieve. in terms of the regulation, the rules and principle, and the regulatory bodies. We have even gone ahead to look at the body that actually developed IFRS. But shockingly, I kind of asked you guys how we develop, how this ISB or IFRS Foundation, how they actually develop this IFRS. How did they develop it? There was a diet I can ask you guys. So you need to know. So you see, the way they develop this IFRS, please listen and understand it very well. The way they develop this IFRS is not like the IFRS Foundation or the people they delegated it to, the IASB. They sit down in a corner and they start writing, this is how you recognize this item, this is how you measure. No, it's not like that though. They don't do that. In fact, the way they develop standard is they ensure that the best thinking worldwide informs the development of this standard. They ensure that the most intelligent people are involved. I mean, they collect the wisdom of the public to develop the standard. It's a collective effort. And from here, you will see what I'm talking about. So it's very open. Look at it. Where is it again? Yeah. It's open, it's a due process, it's transparent, the conduct is accountable. I mean, and the first step, we call it agenda consultation. Sometimes I call it public consultation. That's the first step in developing this IFRS. And the way they consult is that every 5 years, they will come up with a work plan. That means this work plan is something they have been building up, they have been developing over 5 years. So every 5 years, they will say, this is our work plan. And this work plan, what is inside are accounting problems. There are accounting challenges. If there is any standard that people are finding difficult to apply, they will put it in their work plan. If there is any issue or transaction that there is no standard for, they will put it in their work plan. I mean, the accounting problems, the challenges we face in practice, they collect it over 5 years. And it's not some set of people sitting down to think about these problems. These are things that are happening to people, that are happening to accountants, that are happening to accounting firms. That's the challenges they face. So they document it. And of course, it's through consultation. So step one is to come up with a project work plan through agenda consultation. So they build up an agenda, a project work plan. Then step two, now that they have a problem, then they will research into it. Like most of you in this class will have gone through undergraduate courses or even masters. Some of them might even done PhD. And at every level of this education, you will see that you are required to carry out a research. You will do field work. Even when you're doing PhD, for the most part of the years, for almost 4 semesters, not do coursework, it will be field work. You would research on a problem. And that is exactly that process you go through, whether in your undergraduate or your postgraduate, is the same thing these guys do in step two. They research that, okay, we have this accounting problem. Let's research it. Does this problem exist? Is there a solution for it? They research. They will use estimation techniques. They will use pre-estimation techniques, all of those techniques that you know, whether ALDL, name them, that we use to estimate and analyze data. They will do that research. Now, their research, they come out with a research report, which they will put in a discussion paper that, okay, from our research, these are the problems, that this problem actually exists, and these are the solutions that can work. They won't keep the report to themselves. They will send it to the public. They will send it to professionals. Ask for their inputs. Ask for their opinions. They collect it together. They review people's opinion. They will refine it. I mean, that opinion would refine this discussion paper to a level that is where they would decide whether their research is correct or wrong. Because people that are really working with them, this solution will not work. Oh. This cannot work. Or we'll say, this solution, you have not put this one there, add this one. A lot of opinions and comments that they will get. Then it is at this level that they will decide that this problem we are saying it exists, that we put in our work plan, does it actually exist? It is at this level that they will decide whether they want to go into the effort of developing a new standard or go into the effort of amending an existing standard. It is at this level they will decide from this discussion paper, from this research report that they send out to the public. So when the refined discussion paper informs them that they can go ahead, then we go to step 3, which is the standard setting program. And the first thing they do in this step 3 is to come up with a proposal for a new accounting standard or amendment to an accounting standard. You see, this project is either they want to develop a new standard or amend. Like they just amended IAS 1 to IFRS 18. That's an amendment, right? Even though they didn't maintain IAS 1, they brought in a new name. I mean, most of you should have observed that now we are transitioning from IAS to, we don't want to call this standard IAS anymore. We want to call them IFRS. That's why most of the time when they amend existing standards, they just change the name to IFRS. They just change the name to IFRS like that. And if they bring in a new standard, they will just call it IFRS like that, right? So in this step 3, when we are developing standards, the first thing is to come up with a proposal. Because now they have a good understanding of the problem, they have a good understanding of the possible solution. Then they will put it in a proposal. They would organize it in something that looks similar to your accounting standard. And these documents, they will publish it. They will call it an exposure draft. It's called an exposure draft. You can Google exposure draft that has been issued in the past. You will see it. It's there. It's everywhere. They will send it to the public. And this exposure draft, that is where you will find the recognition criteria they are proposing. They will have many. It will be plenty. And they will explain the brain behind everything. It's always bulky. The measurement bases that they are looking at, plenty, they will explain and everything in detail. Then people will look at it, people will criticize it, people will comment, send in opinions. I mean, it's a lot of effort from these guys. It's a lot of work. So it can be on exposure draft for years because at every point they send it out to the public, they will give it 90 days to get comments and opinions. When they review those comments and opinions, if they are not satisfied, they send it out again. They update it, they send it out. I mean, they could be on that cycle, 4 or 5 cycle, 2, 3 years like that. Ultimately, after they have refined their exposure drafts and they have an identified recognition criteria, an identified measurement basis that everybody agreed to, they issue a new standard or they amend the existing standard. And that's it. We have a new standard. And of course, these guys will not stop there. They need to maintain it. They need to ensure that people can apply it. So they continue to monitor its application. And that is where the IFRS Interpretation Committee comes in. If there are conflict of opinions in terms of its application, in terms of its interpretation, they come up with an interpretation. Or they might then go back again and put it in a work plan. Like the cycle will then continue from there again. On and on, on and on, on and on. So these are the steps in developing an accounting standard. Okay, and that's it for today. I'll just give you an assignment. I want you to research into reasons why regulation is important. Why the regulation of reporting is important in Nigeria. Guys, I hope you appreciate the fact that we have started. This assignment I'm giving you, these things I'm saying read, these are past questions. These are things they have asked in the past. These are things that necessarily you don't have to cram what I've written in these notes for you to get points in the exam. We would really want you to also have a say. There are things you can think about and come up with some reasonable opinions about. Okay, so read about it, learn about it, and see if you can come up with some reasonable answers. In the past, I think in 2022 May, they have asked about the major benefit and criticism of principle-based accounting standards, the consequences of transiting from rule-based to principle-based. They have asked about the rationale behind different regulatory framework. I mean, this is the assignment I gave you now. 8 marks. Rationale. This is talking about why is regulation necessary. And they have also asked you about various sources of regulation, which is the company law, accounting standards, local stock exchange listing requirement. I intentionally not put the solution here so that you can at least make some effort like that. So congratulations to you guys. We have successfully covered our first topic, and that's good. So most